I think volatility is really healthy, and we should demand it on both sides. And what you've seen is, though, to your point, the drawdowns in Bitcoin are no longer that violent in the way that it doesn't stay there for very long. Mm-hmm. So this is the key. When you have big liquidation events or like macro resets like FTX, for example, there's some structural oversupply that comes to market where there's no bid, and it remains suppressed for a long period of time. And what you've seen with almost most of the drawdowns we've experienced is there's often a pretty quick bid. And that I think is really good, because to your point, it limits the drawdown to, I think, lower ranges. And that is a healthy sign that there's like renewed appetite and risk appetite coming for Bitcoin too.
Jeff's optimism begins with market structure. By the end of December, a massive amount of derivatives exposure rolled off the books. Large options, X-rays, futures contracts, and structured positions that dominated 2025 simply expired. That matters more than most people realize. In 2025, the market wasn't trading freely. It was constrained. A huge portion of investors had sold covered calls early in the year, many in January and February, expecting moderate upside following political tailwinds and renewed enthusiasm. Those calls often expired in June, September, and December, meaning they hung over the market all year long. That kind of positioning creates what Jeff describes as liquidity black holes. When upside momentum appears, it gets absorbed. When volatility tries to expand, it gets crushed. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
2026, I think, will be a really fun year. I think it'll be great for Bitcoin. And right now, what's happened is we have a clean slate. So after December, large option expiries rolled off, a lot of futures rolled off. And so we basically have little leverage in the system, and it's a clean board for everyone to start building new positions to anticipate 3 months, 6 months, 1 year from now. So that's great, because there's no inertia and gravity that is counteracting pre-existing positions that people might have had that seasoned throughout 2025. And what I've been sharing with investors is that 2025 was really marked by a bunch of covered call selling activities. So if you were coming in 2025 in January and February and you were selling calls expiring in June, September, December, because you were really excited about Bitcoin momentum post-Trump, all of those calls you had sold were in existence for the year, and they were creating different kinds of liquidity black holes, if you would. Those are all gone. So it's a clean year, which I love. And you can actually kind of see that already in the options market. You can see it because right after December 31st, you saw the call skew finally steepen after basically 3 months of having shown no activity. When call skew steepens, what that means is that investors are either buying upside calls freshly to bring vol bid back up, or on the other side, investors are not selling calls to suppress volatility on the upside. And so one of the big theses I had was 3Q, 4Q was really dominated by a lot of cover call selling activities, which is why Bitcoin never got the chance to really squeeze to the upside. And for now, 6 days into the new year, we are seeing renewed activity to the upside. We saw lots of call buying yesterday, which is really exciting. Love seeing the green blocks come through for upside. And then we also saw people just buying very outsized, far out of the money strangles. Strangles are when you buy calls and puts that are both out of the money. So it's not making a directional bet, it's making a bet on volatility itself. And this investor is basically saying whether it goes up or down, volatility is going to be higher for 2026. And I think that is the key message for not just Bitcoin, but for generally risk assets globally heading into a really exciting year. I think volatility in general for upside and downside is healthy for Bitcoin. And I know people don't like it when Bitcoin goes down and vol goes up because they think that is net value destructive for your bags. But the reality is, anytime there's volatility, even to the downside, means there's uncertainty. And the flip side of uncertainty is always opportunity. So it allows new investors to consider Bitcoin that may have been waiting on the sideline, or they're looking to buy it at a deep discount value. And those types of kind of trading behaviors and new investor capital formation that can only happen when there's a lot more volatility. So I think we need these kind of drawdowns because it allows like new capital to also step in that resets their holding period. That's the other thing. When you buy Bitcoin, I know there are those that are out there that permanently plan to own it forever, but the ETF channel investors are a little bit different. I think these are more your professional investors that are in the business of portfolio construction and portfolio optimization. So they are looking for Bitcoin to play a certain role. And if it doesn't play the role, they're going to get out of it. But that also means there's new investors coming in and it resets their IRR. It resets to day zero. So now they can underwrite it for 2 more years. And you need to kind of always rotate and cycle amongst existing investors to new investors, because that's ultimately how capital graduates. So I think volatility is really healthy, and we should demand it on both sides. And when what you've seen is, though, to your point, the drawdowns in Bitcoin are no longer that violent in the way that it doesn't stay there for very long. So this is the key. When you have big liquidation events or like macro resets, like FTX, for example, there's some structural oversupply that comes to market where there's no bid, and it remains suppressed for a long period of time. And what you've seen with almost most of the drawdowns we've experienced is there's often a pretty quick bid, and that I think is really good, because to your point, it limits the drawdown to, I think, lower ranges. And that is a healthy sign that there's like renewed appetite and risk appetite coming for Bitcoin too.
Morgan Stanley's decision to launch a Bitcoin ETF and a Solana ETF is a subtle but powerful signal of how Wall Street is starting to view crypto. What stands out most is not just what they included, but what they left out: Ethereum. Jeff Park interprets this as a shift toward a barbell approach, where institutions favor assets with very clear roles rather than those stuck in the middle. On one end of that barbell is Bitcoin, which offers permanence, simplicity, and a hedge against systemic risk. It's easy for institutions to understand, explain, and justify. On the other end is Solana, which represents speed, experimentation, and high-performance crypto infrastructure that aligns with trading, speculation, and technological innovation. Both assets have clear product-market fit from a Wall Street perspective.
All right, last thing I want to talk about, Morgan Stanley announced this week that they are going to launch Bitcoin ETF and a Solana ETF. What are your big takeaways from this?
3 big takeaways. The first big takeaway is I thought it was funny they didn't choose Ethereum as one of the 3.
Why do you think they didn't do that?
Oh man, it's a loaded question. I've held the view for product market fit in general, especially towards Wall Street. The barbell theory of investing in crypto was always Bitcoin and Solana. And the reason is because it's very easy to bet on vices and things that are basically kind of like what I call short humanity. And I don't mean like Bitcoin is genuinely a short humanity, but what I mean is Bitcoin is like a world-ending hedge, right? So it's a little bit of like a hedge against that as a vice. And Solana for a long time, I think, was the kind of meme coin proxy, right? So it was like a gambling proxy for crypto to bet on. That humans love to gamble. Humans love to predict. Humans love to kind of do these things that Solana has captured the mind share for, because it's built literally to optimize for that with as low latency as possible. So it found product market fit. And so from that barbell approach, Bitcoin is, never going to change because it's Bitcoin. Great. Solana, very quick to change, very fast accelerating, like tons of technologists and futurists working on new paradigms of tokenization and all the ways like crypto rails are going to start affecting our infrastructure. And so it's really like a sandbox for like pure max tech. Ethereum's like literally neither here nor there, right? It's kind of not Bitcoin, and it's not that fast. And the one virtue it seems to consistently signal, sometimes to my annoyance, is this concept of like decentralization. When in reality, we all know, we just talked about kids using AI to do whatever they want in the future. They don't care about decentralization at the core if you're gonna sacrifice productivity gains from it. So I think Solana in some ways represents that Wall Street ethos because it's about tech maximization. And the Rails Solana's built has been kind of done with the DNA of like a high frequency trader. If you look at a lot of the projects that came out of Solana originally, they're kind of like the things that the Jumps and the Jane Street types would have backed, because you're trying to create like a better trading infrastructure. I mean, that's a Wall Street game. So I think Solana has product market fit. Bitcoin does too. I think Morgan Stanley, in a slightly soft way, is almost making that claim as well, because it should have been obvious Ethereum should have been on that list if they felt any differently about it. So that was the first thing that caught my eye. The second thing is, man, like I think Morgan Stanley is like a sleeping giant for crypto. And I've said this for a while now, but they have all the vertical rails to make crypto as integrated as possible for the consumer experience, right? First of all, they have wealth management that is now, I think, close to like 15, 20,000 advisors on their platform. A giant beast post 2008 when James Gorman came in and reshaped Morgan Stanley away from the Goldman model. And that is now almost 20 years ago. So we're reaping the dividends of that. Two, it has E-Trade, which sometimes people forget. Like E-Trade is now part of Morgan Stanley's direct like retail reach. And then you have E-Trade offering crypto trading via partnership with Zero Hash. So they've done things towards a lens towards tokenization and tokenized equities. And now they're bringing basically the ETF game into the system. I was told that it's very rare for Morgan Stanley to launch its own branded ETFs because they've acquired others in the past. Like Eaton Vance is a good example. Like, but they don't label it as Morgan Stanley products. But this will be, which is kind of in a way a historic thing to just show their might of distribution. So I think that's really interesting. But I think 2026 is the year where people are going to really understand that authenticity matters so much, but the way that they're going to judge this is their own criteria for measurement is going to be more fine-tuned. You've seen people now pick up what is now called like AI slop in the social universe, where you can kind of have telltale signs of things that are like, you know, maybe AI generated. And people are quick to equate that to mean that those are therefore not of high quality. And it's interesting because the definition of quality comes to play, right? Because like when you have made in China like sneakers, right, by child labor, you know, which was not great in the 90s, it's hard to know if those are like actually badly made or just cheaply made, and what people felt about that to be like an authentic experience of a good that represents their values, right? I would almost argue that those sneakers are probably better than my current like on sneakers, which every day seems to get a hole like every month. And so they're not well made anymore. So I think the bar is going higher. And in that sense, like everyone is going to start craving for more realness. And that realness then translates into like really idiosyncratic behavior, right? Because think about it again, like LLMs, they learn by regurgitating past behavior at scale. So the only way to differentiate yourself from past behaviors at scale is to do new behaviors that are so idiosyncratic or your own that it cannot possibly be confused with AI. So I think 2026 is going to be a year of like total wildness in terms of people acting out almost, not just for the sake of like wanting to get their message through, but over exaggerating the call for authenticity in a way that they can stand by and say, this is authentically me, because it couldn't be other way around. You also saw Vivek Ramaswamy recently gave up Twitter. I don't know if
Instagram too, I think. Yeah.
Instagram as well. I see. So, you know, and his whole view was that Twitter is net negative if the feedback loop is ever so constant, where it's starting to affect his political message and not the other way around. So instead of being the outlet for information, it's becoming the thing that shapes the information that he wants.
Programming.
Yeah. And if this is the direction in which like AI content goes, we're all probably going to feel a little bit of wanting to like resist that as much as possible to get a sense of independence of your own thoughts.
Jeff Park's message is clear. 2026 isn't just another year in the cycle. It's a reset. The leverage is gone. The suppression is gone. Volatility is returning, not as chaos, but as opportunity. Bitcoin is entering a phase where drawdowns are shorter, demand is deeper, institutions are more prepared, and authenticity matters more than ever. Volatility will test conviction, but it will also invite new believers. And if Jeff is right, 2026 won't just be fun. It may be the year Bitcoin finally trades like what it's becoming, a mature, global, and indispensable asset.